I wanted to talk today about defined benefit plans. And before we get into the meat of it, I work with closely held businesses doing qualified plans, have for 35 years. And even today, a lot of times when I talk about defined benefit plans, people will tell me they're really surprised. They think nobody does defined benefit plans anymore, that they're dead. Nobody wants to do them. And that is certainly true in the big corporate plan market. But the very reason that the big corporations have moved away from defined benefit plans is exactly why they work wonderfully for closely held businesses, because they are expensive. A defined benefit plan enables a business owner to put in substantially more money than they could in a 401k plan or a profit-sharing plan. And 401ks now have just permeated this marketplace, but there are lots of other plan choices. We write a lot of defined benefit plans. I think probably plans that we brought in last year, maybe in my marketplace of the closely held businesses, maybe half of them were defined benefit plans. So there's tremendous opportunity here because other people aren't talking to business owners about these plans. And when I go into a business owner who's very successful, and if we talk 401k, okay, great, you can make an $18,000 salary deferral, or we could talk about a defined benefit plan, and maybe you could make a $300,000 deductible contribution. What would you be more interested in? So that's just kind of the overview. So this is where it starts. Are you having a good year? Then so is Uncle Sam, because the more you make, the more you pay. I haven't found anybody yet who wouldn't like to pay less taxes. Everybody feels better when they pay less taxes. Also, defined benefit plans can be an excellent tool for actually helping someone get to retirement. Business owners who are successful, they have cash flow. That doesn't mean they're good savers. They find lots of things to do with that money. Some people are savers and some are not, but many of them will find are not really planning for retirement. They put money away. So here's our qualified world. As we go up the pyramid, the contributions actually get smaller. So at the bottom of the pile is a full 412E3, fully insured defined benefit plan. Those used to be 412I plans. Those potentially have the largest contributions, followed by traditional defined benefit plan. And then cash balance is kind of a hybrid plan. It is a defined benefit plan, but it looks like a defined contribution plan. So they're kind of next up the rung. Then we have profit sharing and 401k. Which limit the amount of contributions. So today we're going to talk about the traditional and the 412. We have another call scheduled, I think in a couple of weeks. We'll talk about the 401k and profit sharing. But all the qualified plans are 100% deductible. They also have the benefit of if you have one rank and file employee in there with the owner, they've got full protection from creditors. This is important to some business owners. This is money that no one can ever get to. The only ones who can get to that money is the IRS and your spouse. So it's a very protected place to put money. And of course, qualified plans are effective ways to accumulate money for retirement. So on the top of the pyramid is a distribution solution, a strategy for getting the money out and getting the tax bill down on the way out. So that's for another day. We're not going to talk about that today, but maybe on another day. So let's talk about the world that we're looking at here. We've got 30 million businesses with less than 10 employees out there. If you just look at 50 employees and less than 44% of those businesses have any retirement plan in place, and only 9% have a defined benefit. If you drop that down to actually companies with less than 10 employees, you will find that only 1% have a defined benefit plan in place. And that's not because the plans won't work for them, it's because no one is talking to them about that. So here's overlaid that with our baby boomers. We've got 80 million baby boomers. Something like, I heard like 13,000 baby boomers are turning 65 a day, something like that. It's some astronomical number. So we've got a lot of people in that position of approaching or taking retirement. And this to me is a really scary slide. Now this is from 2007. I've been trying to get an updated version of this study since then, and they don't have one out. But the account balances haven't changed that dramatically because we had the big drop in 2008 and then recovery. But participants in their 50s, the average balance is just over $127,000, with 50% of those accounts were below $70,000. I think those are pretty frightening statistics. And you would think, right, you've got a business owner, successful, making lots of money, that they have much higher account balances. Sometimes they do, but frequently they do not. As I said, you know, some people are savers, some are not. They have great equipment in their company. They have really nice toys. They have nice cars, nice boats, nice houses, not necessarily nice flush retirement accounts. So when I'm talking to business owners, you know, what usually is their plan for retirement? You know, probably 9 out of 10 will tell you their plan for retirement is they're going to sell the business. Well, that's nice if you can find a buyer. That's nice if the economy is good, but what if at the time you want to retire, those things are not so good? It could be very difficult to sell your business. It could be very difficult to find a buyer. It could be very difficult to get what you think the business is worth. And then what does that business owner do if that's the case? And frequently, you know, basically they come down to two choices. They could sell it or not sell it, do whatever they can to get out and retire on whatever they've got, and adjust their lifestyle accordingly. Or if we had put in a qualified plan in the years when they had the cash flow and they were flush with money to do that, we would have gotten a current tax deduction. We would have gotten that money into a protected place, and now they would have an accumulation of money for retirement. So they would have some choices. And right now in a defined benefit plan, we can accumulate about $2.5 million for someone, assuming they've got the time and the income to do that. Now, that may not be all the money they need for retirement. It depends on their lifestyle. But even if it's not all they need, it could be a nice step up to being ready. So I see this slide. You know, if I'm sitting in front of a business owner and I ask that business owner, what's your plan for retirement? And you get that either dead silence that comes back or they don't have a plan. And they need one. They need to have one, or they may never be able to comfortably retire from that business. So let's start at the beginning. Here's someone who makes $175,000 of taxable income. After all the deductions, that puts them at a 29% federal marginal tax bracket. That means they pay $50,819 in taxes. Now let's presume that they're 40 and they're going to do this for the next 25 years. I'm going to presume nothing changes. Same earnings, no tax rate increases, just multiply that number by 25. That's $1,270,000 in taxes they'll pay over the next 25 years on that annual $175,000 of earnings. So we could put in a qualified plan. This would be a little solo pay plan if anyone cares. We put in $53,000. That would save this person $18,000 in current taxes because of the deduction. And now if we did that for 25 years, that would put $450,000 to work for that business owner that they would have otherwise paid in taxes. So that's just the tax savings we're looking at. So, you know, either pay it to the IRS or put it in a plan. You get to keep it and put it to work for yourself. Now, I don't know what that money might do. I grew it at 5% here. At 5% in 25 years, we'd have about $900,000. Now, when that money comes out, it will be taxable. So there are certainly arguments being made in the current economic environment that if you think tax rates will go up, now, I personally don't have that crystal ball. I don't know what the tax rates will be in 25 years. I can't even guess. That's a long time. But if you really think tax rates are going up, a case can be made, don't put the money away pre-tax because you're going to pay a higher tax rate when it comes out. Yes, but you have to put in that equation that we got to use money that we otherwise didn't have. So this is just a snapshot of the tax savings. If we didn't do the plan, $450,000 is gone in taxes, just gone. We do the plan, we bring that back, we put it to work for the business owner, it grows to $900,000, pick a tax rate when it comes out. If it's 50%, they still end up with $450,000 that they otherwise wouldn't have at all. If it's 90%, they end up with $81,000 that they wouldn't have had at all. So there's definitely advantage to getting to use the money that otherwise we wouldn't have the opportunity to use. Now, it can be pretty simple when it's a one-person business. It gets a little more tricky when there are employees. Most business owners don't want to put money in for the employees. They're not looking for employee benefit programs. Sometimes they are, but most of the time they're not. And that's fine. The key is plan design. When we design a plan, we design it around the objectives of the business owner. If they want the money all to them, that's what we're going to try and do. Now, we'll have to give some money to the employees. We have to pass rules. But if we can get that plan efficient enough so that the tax savings more than covers whatever we have to put for the employees, plus adds to the owner's account, then we're going to come out ahead. So here's a little example, a little closely held business. We've got Pat and Chris own this business. Their child Drew is in the business with them, and they've got 2 employees working for them. This is a profit sharing plan. We're able to put $53,000 in for each Pat and Chris. Drew is along for the ride, gets $56.39, and all we have to put in for the 2 employees is $22.50 and $1,500. So what does this really cost the employer? The total plan contribution is $115,389. At a 34% tax rate, their tax savings, because of the deduction for that, will be $39,232. So their net after-tax out-of-pocket cost for the plan is only $76,157. The owners and Drew are getting $111,639 of that $115,000 contribution. So by putting in the plan, they come out ahead $35,482. That $37.50 we gave for the 2 employees came out of the tax savings. It didn't come out of the business owner's pocket, and the rest of the tax savings went to work for the business owners. If they didn't do this plan, or while they're not doing this plan, they're paying $39,232. They don't get to keep that money. They're paying it in taxes. We get to pull it back when we get the deduction for the qualified plan. Now, this is a profit sharing plan. When we do this with a defined benefit plan, we'll get the same leverage. The numbers just get bigger. So defined contribution plan, we are limited. The employer contribution is limited to 25% of the total payroll for all the employees. And no individual can get more than 100% of their pay to a maximum of $53,000. The exception to that is if you're 50 or older and you have a 401k salary deferral piece in there, you can do a catch-up on top of that of $6,000. That would be $59,000. But that's the most you could ever get in a defined contribution scenario. So let's switch now and look at what a defined benefit plan can do, right? It's a qualified plan, same rules, same tax advantages. It's just a matter of how much we can put in and what the benefit will look like. The first thing that a defined benefit plan does is it brings some certainty into the picture, because here the amount of benefit you will get at retirement is defined in the plan document. You know exactly what you're going to get. Unlike think about a 401k, we know what we're putting in. We have no idea how much money we'll have for retirement when we're in a 401k plan. Great savings plans, terrible retirement programs, because you don't know what you're going to have. Here you know exactly what you're going to have. The benefit is defined by the plan document, and then how much has to be put in each year to fund that benefit is the number that's backed into, and that's what the actuary does. We can set up these plans so they have guaranteed returns, guaranteed death benefits, predictable costs, they have the protection from creditors, and the current income tax deduction. So there's flexibility in that world, but we can give that employer all those things. So for baby boomers, or 80 million baby boomers, one of the big advantages for the people who have the cash flow is that we can accumulate a much bigger benefit in a much shorter period of time than we could through a 401k or a profit sharing plan. And so if they have the cash flow to do that or want the deductions in doing that, then this could be appealing. Here's a 55-year-old, right? If we did the profit sharing, actually this would be $53,000 this year if they had enough income. The defined benefit contribution is almost $137,000 for that 55-year-old. How much money do they have to work with? How much money do they want to contribute? Benefit for this person depends what their income is. If I played that $53,000 out in the profit sharing group at 5%, I could have somewhere under $700,000, maybe $660,000, somewhere in there. The defined benefit plan, now the lump sum you can take from a defined benefit plan changes a little bit from time to time because interest rates play into that number. But right now, you could take about this $2.4 million, sometimes it's as much as $2.5 million as a lump sum. Much, much bigger retirement benefit, and you would know that money is going to be there. There are different types of defined benefit plans. Traditional is the one that most of us think of. It's been around since the 1930s. It'll say something like you'll receive a retirement benefit at age 65 of 20% of pay. You know, something like that. That's been around forever. There are two versions. It just has to do with how we test it. The general testing gives us more flexibility in design because it's a little more sophisticated testing. Then we have fully insured plans. We'll get into those a little bit on the call today. These used to be 412I, now they're 412E3. And then the last one is the new kid on the block, which is cash balance, which, as I said, is at its root a defined benefit plan. So it gives us potentially much larger contributions. But it looks a lot like a defined contribution plan because it has what looks like individual accounts. That's how the benefit is defined. I'm not going to talk about those today. That could be a call all in itself. So we can only cover so much in the amount of time. So we're going to stay with traditional and fully insured. So how much of a benefit can we get? The maximum annual benefit in any defined benefit plan, and that includes cash balance, is the higher of either 100% of pay, we can't exceed 100% of pay, or a life annuity of $210,000 a year, payable at retirement age. Retirement age can be low as age 62 or as high as age 65. We can't go outside of that window. The contribution will be whatever is required to fund that benefit. The maximum compensation we can recognize for plan purposes to do our calculations is $265,000. So if I have a business owner who's earning $900,000, it's good for them, but I can only recognize $265,000 when I do my design. And that's the same for all qualified plans. So how much will the contribution be? It depends. It depends how old they are when we start the plan. It depends what the retirement age is that we use, how many years of service they'll have, and what their average compensation is. The plan will lock in on their three highest average years of compensation, usually the way we define them. Now, when we get into the defined benefit world, you are on the hook to do some contributions here because, remember, our benefit is defined and promised by the plan document. So the employer does have to make ongoing contributions. They can't, unlike a profit-sharing plan, they can't get to the end of the year and say, you know, it was a bad year, I'm not going to contribute this year. In a traditional defined benefit, they will get a range of contribution, but there will be a minimum that's required. There'll be a maximum they can do, and they could contribute anywhere in that range. But they will have to contribute annually. Those contributions have to be in within 8.5 months of the end of the plan year. Larger plans have to make quarterly payments. Usually the smaller plans that we're working with don't have to. And the IRS will come after you if you don't meet those minimum funding requirements. So sometimes employers get afraid of all that, and they shouldn't be afraid. You know, it's good to be aware and concerned, but, you know, it's always, well, what if things change? So when we're looking to put in a defined benefit plan, we never want to put one into a business where their income is very erratic. There are certain industries that are like that. But if it's a business that's had a good, strong earnings history, you know, for 5 years or 7 years or whatever, there's no reason not to put a plan in. If something happens in the future, we don't have that crystal ball. Things could always happen. We can get out of this. It's not pension prison. So we can always reduce the plan formula to take the pressure off on the contributions. If things get really bad, we can always terminate the plan. And we can also do some conversion and design changes to also help alleviate that pressure should that employer get to in a position where suddenly their world has changed and they need that relief. Pension Benefit Guaranty Corporation is a government organization that insures defined benefit plans. So what does that mean? If you are a defined benefit plan subject to PBGC, not all of them are. If you have no employees in your plan, you're not. If you're a professional corporation with less than 25 employees, you are not. But other plans that are means the employer will have to pay a premium into this government program. It's not elective, it's mandatory. What the PBGC is, they're ensuring benefits of if that employer went bankrupt and that plan folded, the employees would get a certain level of promised benefit insured by the government. It's not a big deal. Every once in a while there's a lot of talk when the PBGC premiums go up, but frankly it's really not a big deal. In our plan world, it could be if you have 10,000 employees, But when we're doing plans that are very small, our typical client will have less than 5 employees. This is usually not an issue. So here's my same little group, and you can see this is just a plain vanilla traditional defined benefit plan. Now we've gone from giving the owners $53,000 to contributions of $178,000 and $141,000. Those numbers are driven by their age, and they are different ages. That's why they are different, even though their compensation was the same. Now, Drew's contribution dropped way down because Drew was young. Employee 1 is also very low. Employee 2 was, I think, 60 in my census. So employee 2's number is up, but still in the greater scheme of things, this is very favorable for Pat and Chris. All right, there we go. All right, so we'll get into that a little bit more, but let's talk about life insurance for a second. Lots of life insurance is written in defined benefit plans, both traditional plans and fully insured plans. And there are some reasons for that we'll talk about. So it doesn't make sense. 3 abs 20 will die before they reach age 65. There's the most depressing flaw of the presentation. That includes business owners. They are not immune. And so sometimes we're putting life insurance in to protect that benefit. Let's say we're planning to accumulate that $2.5 million, and the business owner has a spouse at home. Well, maybe they're counting together. They're counting on that $2.5 million for their retirement. Well, should the business owner person not make it, that $2.5 million won't be there yet. Some piece of it will be there, but it won't all be there. So sometimes we're just including life insurance to make that plan self-completing for the surviving spouse. For what it's worth, for those who make it, 100% will die after age 65, so we know that benefit will pay sometime. All right, so we can't put all the money into the life insurance. We have to stay within incidental limits. But we can put quite a bit. But here's some reason we're going to pay all the premium with pre-tax dollars, because it's going to be paid with contribution dollars. It will provide those survivor benefits in the event of premature death to make that benefit self-completing. The pure death benefit does pass to the beneficiary income tax-free, even though the premium was deductible. Any cash value in the policy is taxable as a retirement payment because you could have just surrendered the policy for cash. But the pure death benefit is always income tax-free. And these are always permanent policies. We've never used term here. So those policies will continue after retirement. The insured takes that policy with them. Depending on how we design the plan, we could have that policy paid up at retirement so they don't have to pay any future premiums. If we don't want to pay it up, we can do that too. So, here's somebody in a defined benefit plan with no insurance in the plan. This particular individual will funding for a lump sum at their retirement of about $1.3 million. They're not at the maximum. Now, in a defined benefit, you are earning that benefit each year, called accrual, right? You're accruing the benefit towards that goal each year. So I presumed here that my individual, at this point in time has an accrued benefit of $712,347 towards that 1322. Now, if I add insurance to the plan, I can't eat away at that benefit. That's promised by the plan document. So they would receive the same $1.3 million in retirement. Their current accrual is that same $712,347. But now I've also added a death benefit. So let's presume that person actually died this year. Their accrued benefit is $712,347. So if they died without insurance in the plan, that's what their beneficiary would get. But here we've added $5.3 million of death benefits. So now at their death, their beneficiary would get the accrued benefit and the life insurance of $5.3 million. And remember, the pure amount at risk on that policy is all income tax free. So obviously a much, much greater benefit for the beneficiary. Also, from another perspective, when we add life insurance to a defined benefit plan, it will increase the plan contribution because there is a cost. We have to add this on top of the benefit. So sometimes that's exactly what companies want. They're looking for that maximum deduction, and if they're looking for that absolute maximum deduction, they may not have even thought about insurance, but frankly, if we're going to get there, we have to use insurance. Also, we've used it in plans we have found that are overfunded, which is a really bad situation. we can suck up some of that overfunding by adding life insurance into that plan. All right, so let's look at the numbers. Here's just a little example. Here's my 55-year-old again. If we did this plan with no insurance, this particular one is going to provide a little over $2.2 million at retirement, lump sum. The plan contribution is $137,258. We add $1 million here. We could do a lot more, but just for the sample, we're going to put in $1 million of insurance. In addition to that benefit, you'll see their value at retirement is unchanged because we can't eat away at that. But now their plan contribution went up to $138,000 to add that $1 million of death benefit. So to give you some perspective, the plan contribution went up $642. That is deductible as plan contribution, so out of pocket it's going to cost them, let's say, about $400. The premium for this policy is $28,600. So if they were to buy this $1 million of coverage outside the plan, they would need gross earnings, I don't know, $50,000 to pay the tax to net the premium to pay it. Here it's an out-of-pocket cost of about $400. Why wouldn't you add $1 million of death benefit protection for $400? I don't know why you wouldn't. All right, so let's go a step further. As I said, in a traditional defined benefit plan, we can include the insurance. That's how it will work. The rest of the money is invested and can be placed almost anywhere the employer wants. A lot of times they're in brokerage accounts, have a range of investments, and so there's some risk along with that because the market goes up, but it also goes down. If that employer really wants guarantees, this is when we start to talk about doing a 412E3 plan. Now, a fully insured defined benefit plan is just like a traditional defined benefit plan, except the money can only be deposited in level premium annuity contracts, and if you have whole insurance, you don't have to, but if you do, it has to be whole life. So everything in this plan is guaranteed. Guaranteed returns, guaranteed death benefits, very level predictable costs. We still have the creditor protection, and we still have the income tax deduction. So funded solely with insurance company contracts. You cannot just go to any insurance company and pull their off-the-shelf contracts. They have to meet the requirements. You need an annuity, a level premium annuity, and if you do life insurance, it has to be whole life, and the two products have to be from the same company because there's a requirement that they are of the same series. So the funding of the plan will be based upon the minimum guarantees of those underlying contracts. So you can imagine the underlying guarantee will be less than market rate. So when we assume a lower rate of return, it will drive up the contribution, particularly in the early years of the plan. So this will really maximize the employer's contribution. But it also guarantees the benefits. We take the market risk out when you go to this kind of plan. So entry age, depends when they're eligible, but that will drive the cost of what the contributions are. And when we have the life insurance, how much life insurance benefit can we buy will be controlled by the incidental limits, which we'll look at in a minute. And the retirement benefit is defined by the plan document at a given retirement age, and will you lock into their average compensation, usually their highest 3 years. There's a little trick there when we're dealing with unincorporated entities. If they've been around for more than 3 years, we can lock into their historical high income and sometimes zero them out for income tax purposes in the current year. All right, so we kind of talked about this. We've got pre-tax payment of premiums, right? So you can buy more insurance with the same amount of dollars, or use the same amount you would have used outside and you can get more benefit with fewer dollars. We've got survivorship benefits in the end of premature death. The death benefit will be income tax free. Also, sometimes we have employers who will buy their insurance here more than what they need to self-insure the plan, just because it's a cheaper place to buy insurance, or maybe they're paying premiums outside the plan right now. So here's my little group. I've got Pat and Chris again. I've made this company a little smaller to throw out the other employee because this is a more typical candidate. But now look down, we're down to 3 people. The contribution for annuity only, no life insurance, would be $447,199. We add the insurance here. You see we're adding $3.8 million of death benefit for Pat, $4.4 million for Chris. Remember, the lump sum will be unchanged. But now the contribution is $600,278. How big a contribution do you want? How many tax dollars are you trying to save? What's your cash flow? We're up to very big numbers now compared to where we started. The total contribution is $600,000. Their tax savings at a 34% tax rate would be $204,094. We're only giving a contribution of $8,123 for that employee, and that would be on a 6-year graded vesting schedule. And remember, they only walk away with their accrued benefit, different than the contribution. Our contribution for the owners is $592,000 and change, and our net after-tax cost is only $396. Clearly, this plan is working in their favor. But let's look at the insurance. When we added the insurance, it increased the plan contribution over doing the annuity only, $123,079. We take off the tax savings, so out of pocket, their actual cost for that is about $81,000. Look at the premiums, $298,108. So you're paying $298,000 of premium here with only $81,000. That's the leveraging you get when you do life insurance in any defined benefit plan. Here's my little group again. So they could do the profit sharing, where we started with the $53,000 each. They could do the traditional defined benefit. They could do both plans together. You can layer these plans. If they wanted to go even higher, we could layer it with the 412E3 instead of the traditional defined benefit plan and get those numbers, obviously, substantially higher. If we did
Mary.
the two plans, yep.
Mary, this is Kathy. I had a question just asked about slide 38. Can you go back there real quick if you got it, 2 seconds?
I can do that.
Okay, so the question that came in is, how does someone with a $265,000 salary put it in $227K? Can you explain that, where the money's actually coming into?
Sure, that's
who's
a great
paying for
question.
this?
That's a great question. The contribution is all employer contribution. So the employees don't elect to participate. They don't put any money. It's all employer contribution. So if I have a business entity that's unincorporated, sole provider, a partnership, every dollar that goes in as contribution is reducing the taxable income of the per individual. So I could not have a contribution that would exceed their income, and in fact, sometimes we go down and down toward zero. If they're a corporation, though, the numbers are completely separate. So if you're a corporation, I have to use W-2. So let's say this was a corporation and Pat had W-2 265. The employer contribution is deductible to the corporation. Here it's 227. It could be unlimited. I mean, actuarially it has to work, but I mean, there's no dollar limit on what that could be. So a lot of times we'll see that happen in a sub-S, where we have people who keep their compensation low on the W-2 but want these big deductions, but they've got the corporate money to do it. Or, as I said, if this company had been around, we could lock in that $265,000 based upon prior compensation. And let's say this year they were a sole proprietor and their taxable income was $265,000. We could put in this 227, reducing their current taxable income to whatever the difference between those two is. What about $35,000, $38,000? So that, I know that's a long-winded answer, but just remember the contribution is different. It's at the employer level. Compensation is at the individual level. The two merge together when we have an unincorporated entity and they feed off each other. But if we have a corporate entity, by formula, your salary has to support the benefit we're funding for, but the dollars to contribute that could easily exceed your pay when those numbers play out that way, and that's fine because it's coming from the corporate dollars.
Thank you.
Hopefully that sort of answers the question. Okay, so here we go. If we did the two plans, right? If they did the profit sharing plan, they had tax savings of $39,232. If they did the traditional, just the plain vanilla defined benefit plan here, they had tax savings of $117,598. Now remember, if we did the 412, we were up to a $600,000 contribution, so we could drive that number way higher. But even just being, conservative here, if we did the two plans together, we could give them current tax savings and this would be every year, of $156,830. That's a pretty substantial number for a little 5-person company, and as I said, we could take it much higher. So kind of how do you do this? I'll do my 2 seconds on what we do, and then talk about how you get started. So Pentegra, I'm with Pentegra. You need administration for these plans. We would run a proposal. I have a little 1-page fact-find form if anybody wants. You can email me. I'll be happy to send it to you if you think you have a candidate. We'll run a proposal design. We custom design every plan. It goes back and forth showing it to the client. Lots of times we refine it till they really like it. If they want to move ahead, then we have to, we enter the plan installation and we do the annual administration. That means we're writing the plan document to set up the plan, and then we'll do the administration every year, everything that's involved in that. We'll work to coordinate the product issue for the products being used and the service. And of course, we always are here for technical backup. We've got lots of people here who know lots of stuff. We work with agents and with clients in multiple ways. Strictly as a TPA, third-party administrator, doing just what I said, where we're setting up the plan and administering it. When we get into the 401ks, we can also act as fiduciary. We offer those services for employers who want us to do that. And lastly, I can also partner with agents when we get into much more sophisticated, kind of in complicated situations. I'm available to help sell the case. That is always your option. You can use this. I'll help on it as a TPA. I'll always help you on the phone. But I'll go that step further if you want help actually selling the case, particularly with the insurance. So what are we trying to do for, when we talk to business owners about this, we're really trying to help them. We're trying to help them preserve what they've built, find their way to the retirement life that they want, not just one they get by default, protect their assets from catastrophic loss, protect their assets from tax erosion as well, and increase wealth potentially for the next generation by doing the life insurance. So with that, my contact information is there. Feel free to email me or call me or whatever if you want to talk further, if you have questions. And I try to keep us running a little bit early. I don't want to hold you too long, but I'll be happy to open up. We can open up, and I'll take questions if you like.
Okay, Mary, I do have a couple questions coming in. Someone wants to know, is this presentation you just did, is this available for public format?
If the question is to use it with the public, I have this version. This is an Asian version, but I have a similar one that can be used with the public, and I'd be happy to share that.
Okay, wonderful. And then another question is they're asking about, and this is basically our relationship with Premier, National Life Group, and then you. They're asking how that all works together. So can you explain what you do with National Life Group?
Sure. Pentegra is independent of National Life Group. They're strictly a pension company. We administer about 5,000 plans. It's a big pension company. But we're just an administrator. We'll work with any carrier that you want to. But we do have a very close relationship with National Life. I was the vice president of pensions for 7 years at National Life. And National Life had their own in-house pension administration business for 75 years that called NERPA. They sold that business to Pentegra, and that's when I moved over. We kept some of those administrators, and we were their exclusive administrator for like the last 5 years. And now they've opened the door, but we do most of their plans. So we have a very close working relationship with National Life, and because of that, we can help kind of move business through the system because we have those connections. But it certainly doesn't mean you have to use National Life. We do a lot of special things with them. We know their products, but if there's a reason you have a desire to use some other carrier, we are fine with that as well.
Okay, wonderful. And then here's another question. How do commissions work? Do we split commissions with Pentegra for their services?
If you're using it strictly as a plan administrator, so we'll do the plan design and we'll get on the phone with you and we'll talk it through. Sometimes we'll get on the phone with you at the client and we'll write the plan document. We do the administration. That's just straight TPA. That's our standard service, and there is no split for that. We just have a straight fee schedule for the client, and if it's National Life connection, we have a special discounted fee schedule. For example, on a On a 412 plan, it'll be $1,500 to set it up and $1,500 a year to administer it. If we get into some of the more sophisticated strategies particular to insurance, that can get somewhat complicated, and we're working with an agent, you feel like you need extra help, that's when I will step in and I will split the case with you if you want that additional help to help. When we get to the distribution strategy, which we didn't talk about in this call, those are almost always split cases because it gets very complicated. But that's always your choice. And Pentegra stance is we are fee-based. We offer that additional service when you want it, but you certainly don't have to use it. If you wanted to stay on a fee basis, we're fine with that.
Wonderful, wonderful. Same question different question from one of the same agents. Are cash balance admin setup cost higher?
Yes, cash balance plans are more expensive. If anyone wants to take a moment, I'll be happy to bring my fee schedule up and you can see what our fees are. They are more complicated, so they are a fair amount higher than any other defined benefit plan. The fees are higher.
Okay.
Also, I'll just toss in, almost always when we do a cash balance plan, the best design strategy is to do it together with a 401k plan. We pair the plans together for testing. So almost always when we design a cash balance, you actually end up with two plans because it works better for the client.
Wonderful. I don't see any more questions from the agents. The agents can always call us today at 1-800-365-8208. Just ask for a life marketer. We should be able to help you here too. Get back to any questions that you might have thought about after this webinar. We appreciate everybody taking their Monday morning to join us on this time. And Mary, you were wonderful. Thank you so much for all this information.
No, thank you so much. It was my pleasure to do it.
Okay, I appreciate it. And someone's asking again for that phone number, 1-800-365-8208. Just ask for a life marketer.